this is forexbrokers.net, and we continue this Trading Academy with another series of technical indicators, this time dedicated to moving averages. Every technical trader in this world heard of moving averages, and this is the first video out of 2 or 3, it depends on how it goes, on the examples that we have. All the examples that appear in this video are in the article that comes with this into this Trading Academy. I only want to emphasize a bit their importance and how to use the moving average, how to understand properly the examples that you see in the articles. A moving average is a trend indicator. It is as important as the RSI if you want. So if you look for an emblematic indicator in the oscillators category, the first thing or the first one to consider is the relative strength index. But if you look for a trend indicator, the first one to consider is the moving average. It is a trend indicator that exists even before computers appeared, even before people were able to use computers to compute complicated mathematical formulas and so on. A moving average, like the name suggests, averages, or a simple moving average, averages the values or the prices from the past in order to provide information for the current price. There are many types of moving averages, all of them covered in this article. A simple moving average, exponential, smoothed, linear weighted, and many others depending on the trading platform, or if you trade with the MetaTrader, you can import them onto the platform and so on. What I'm trying to say is that they all in the end show the same thing, only that some of them are closer to the price when compared with others, reducing the lag that they provide. A moving average considers multiple periods. These are the periods that this moving average considers. This black line here, this is the MA14, and it is applied on the 4-hour chart, and it is applied on the close price. You can change this one, applied on the open price or high or low, whatever, but this is on a close price, and it provides, or it splits the screens into 2 parts. The bigger the number of periods considered, actually this is not the 14. If we go on the objects list, non-objects, let's go indicators, moving average, edit. This is the 200 moving average. How did I know that this is not a 14? Because the more periods is considered, the flatter the moving average, it becomes. A 14 periods moving average will follow the price closely. A 200 changes direction a bit slowly. A 500 becomes horizontal. This is why the 200 moving average is considered to be the mother of all moving averages, if you want, as rarely traders look beyond the 200 periods to establish them, to set up the moving average. Moving forward, the main thing that the moving average does is splitting the screen into 2 parts, bullish or bearish. It is obvious that when the market or the price remains below the moving average, this is bearish. When it is above, it's bullish. In clear trends like this one here, it's very easy to see the market direction. I mean, if you want to go on the long side, then you gotta assume that this is a risky business because you are buying a bearish market. You are not riding the trend, but you are counter trending. You are a trader that tries to pick a bottom in order for the market to change. Any moving average provides support and resistance. The beauty of a moving average is that it follows the price or the support and resistance change in time, becomes dynamic and not horizontal. By the time that it reached the moving average, it hesitated for a while. This being a 4-hour chart, it is almost a day. Then it broke lower. The same moving average that found here support, here found resistance, resistance broken, support, support, support broken, resistance, resistance. As it was in the case with the article dedicated to support and resistance, this ability of price to come to the moving average for multiple times shows actually a weakening of the trend weakness, and after 2 or 3 more retests it is wise to avoid looking for the same market reaction in terms of support or resistance. This is the classic interpretation. Another interpretation is to use it as trading into the same market direction, providing that the market, that the moving average doesn't change the direction often, in the sense that this is the hourly Australian dollar and the US dollar. Now have a look in here. The moving average, the MH200, keeps falling despite the fact that the Aussie bounced, and when it kept rising here, actually the price was not able to break the previous high, and as a matter of fact it even reached below the moving average right at this point. So this is not a bullish setup, the fact that the moving average started to rise, and as a matter of fact it became it started to decline shortly after. It provided a very nice trend moving forward. The same happened here. It failed, the price, when it reached the moving average, it failed to make a new highs, and actually it went and made a new low. So this should be ignored, and by the time that the moving average starts to decline again, we should go short. The same obviously happens here with by the time that it rises, the market is make a new high, and so on and so forth. Continuing with the examples, the bigger the time frame, the more important the outcome. This is still the Australian dollar, US dollar, and check out this declining in moving average, and then the rise of it. And when it starts to decline at this point in time, the price is already below. And this was in 2017. We are in February 2020 now, and look at what trend followed. Only that the moving average is applied on a bigger time frame. On the daily chart is even more complex if you want, because take a look here. The moving average declines. The moving average declines, so it confirms the bearish setup. The moving average then here, by the time that price reaches here, the moving average starts to rise, so it confirms the bullish setup. Here it declines with the price below, confirms the bearish setup. Last but not least, on the weekly time frame, we see a very bearish situation on the Australian dollar, US dollar, and actually this one is valid since the Australian dollar, US dollar broke below parity when it did that in 2013. Well, since then the moving average never looked back. So if you are a trader with a longer term perspective, moving averages, especially bigger one like the MA200 on the bigger time frames, help you very much in finding the right trending conditions, in finding the right trend, and then simply apply the rules of a trend if you have the capital and of course the patience to ride the trend on the weekly chart. Stay tuned for the next video. We will treat the golden and dead crosses with moving averages. Bye bye.